Right. Okay, good afternoon all. As I said, my name is John Phillips. I'm one of the directors of the NACFB. I'll be chairing today's discussion on the UK housing market. And as a Welshman, I thought it'd be very easy to do it this weekend. I was going to have one South African on my left and one Englishman on my right. So I'll just step back and let them talk, but then Adam threw into the mix that he's Canadian. So on that basis, the rugby chat finished very quickly. The housing market, obviously, is where an awful lot of us as brokers, I'm in the residential property world as well, that's where we work, and the last 12 months has seen an awful lot. George's decisions with his 3% and his change in income tax, Brexit, and of course this morning. So there's plenty to discuss. We very much welcome your questions afterwards. But I'll now hand over to Mark Posniak, I'll get the two of them confused, Mark Posniak, of Octopus Property Finance to lead off. Thank you, Mark.
Thank you, John. Has anybody got a can of Red Bull or an espresso? I could do with a serious caffeine injection after last night. Wow. We just saw Brexit times 10. Arguably the biggest ever event for decades. One that will have serious political and economic ramifications for the world and the UK. It's a lot to take in, but we have certainly just entered the unknown. Anyway, I wasn't invited here to debate the US election or how the USA has just trumped Brexit. No, I'm here to talk about something far more important: UK property prices and the state of our beloved housing market in general. I'll start by looking backwards at how the market reacted in the aftermath of the referendum result. Whether you were in or out, and I won't reveal my own position for fear of being lynched by the either 52 or 48% of you on my way out. I think what we can all agree on is that it was a very surreal time. And after last week's High Court ruling on Article 50, it's even more surreal than ever before. What we can also probably agree on is that the worst case scenario many predicted hasn't happened yet. After all, quite a few experts said that if we chose to leave the EU, the property market and the economy would implode. It would, in no uncertain terms, be Armageddon. But that just hasn't proved to be. Yes, the pound has taken a bit of a hammering at the hands of the markets, and that's probably an understatement. But on the economic front, things have been relatively stable. For example, only a week ago it emerged that the economy grew by 0.5% in the third post-referendum quarter. Admittedly, this was lower than the 0.7% growth in the second quarter, but it was above market expectations. And it was in the black, not the red, that some doommongers thought it would be in the immediate days after the vote. And while the property market has definitely slowed down since the referendum, with London in particular coming off the boil after the extreme price growth of recent years, it's by no means gone off a cliff. If anything, recent house price indices show a market that is floating rather than floundering. Transaction levels are down, and there's still a fair bit of caution out there. But at the same time, there is still movement, and the right properties continue to command half-decent prices. Likewise, while mortgage approvals are down relative to last year, again, they haven't collapsed. In fact, the latest data from the Bank of England published at the end of October shows mortgage approvals, which is generally considered a decent gauge of the housing market, were surprisingly resilient in September. But should that come really as a surprise? With interest rates hitting a new low in August and the jobs market and broader economy holding up pretty well, the overall backdrop to the current Brexit-led uncertainty is fairly positive. If there's one threat, it's rising inflation. At the worst, it's benign. As a result, buyers have by no means disappeared into thin air. Demand is still there, if not by the bucket load. The Royal Institute of Chartered Surveyors confirmed as much last month, saying demand saw a modest recovery in September after a period of post-referendum jitters. Another reason for this, and I'm clearly not a psychologist, is that people today are arguably a lot more resilient psychologically than they were a decade ago. They don't just run away at the slightest sniff of uncertainty. Many of today's homeowners have lived through the global financial crisis, and what's happening today is simply not in the same bracket as 2008, 2009. Those dark days post-Lehman Brothers really were a white-knuckle ride, unless you were shorting collateralized debt obligations, in which case it was a license to print money. But my point is, people have become used to uncertainty, and that's probably no bad thing, especially in light of what happened last night. On balance then, while overall it's a buyer's market, it's not completely black and white. Sellers may need to drop asking prices if they want to sell, but they don't have to drop them round their ankles. One thing that's definitely helping sellers out there is the ongoing lack of supply. This structural imbalance within the market really is acting as a glass floor under house prices, despite the current market volatility. It's enabling sellers to stand a lot firmer than they would otherwise. All in all, while the vote to leave the EU has had an impact on the market, it's not been as severe as many said it would be. In fact, the consensus in the industry is that the stamp duty surcharge for second homeowners and landlords that kicked in April has had more effect on the market than Brexit. But even within buy-to-let, there are signs that landlords, having licked their wounds, have started re-emerging, in spite of the tougher borrowing environment that they now face due to enhanced stress testing. In September, according to Rightmove, investor activity bounced back after a 4 or 5 month lull. But in a bricks and mortar obsessed nation like ours, is that really such a surprise? Landlords are nothing if not canny, and it seems they are simply recouping the tax surcharge through a combination of hard negotiation and rent rises. And that, for many, was the Achilles heel of George Osborne's noble plan to level the playing field for first-time buyers and increase the level of home ownership. The very people he's trying to protect and intending to help, younger people who are struggling to get onto the ladder, could be the ones who feel the greatest pain on the back of ever-rising rents. Less pain for the government, however. In the 6 months since the new levy was introduced, the Treasury has raised an extra £670 million. Anyway, enough of looking back. If we now look to the future, then for many the decisive factor is whether we have a hard or soft Brexit. What we negotiate after Article 50 has been triggered will hold the key to the medium-term, if not long-term, performance of the property market. It's largely seen as the defining narrative for the years ahead. While a soft Brexit could see the property market survive relatively unscathed, or at least that's what people are saying, a hard Brexit for many could see the UK isolated economically and politically with all manner of problems. It could be the bricks and mortar equivalent of a black swan event and usher in, according to some commentators, a period of double-digit house price falls. As ever, not everybody agrees. In fact, the CEBR has observed that it could actually cause house prices to rise over time. Why is this? Well, the CEBR notes that around 9% of construction workers in the UK are from the EU, rising to 1 in 3 in London. In other words, if immigration laws are materially changed, then the rate at which homes are built will slow even more. Also, if the pound remains under pressure, then this will continue to invite more investment into the UK from overseas. Again, certain cities and towns could see price rises rise on the back of that. There really are countless factors at play. The reality is that nobody has a clue what's going to happen to the UK property market between now and 2020. It's impossible to predict. When looking forwards, perhaps the best bet is to look back. After all, what we can say is that the property market historically has delivered strong returns. Now, past performance is no guarantee of future performance and all that, but if you're investing for the long term, then it's fair to say that property may not be a bad bet. With interest rates unlikely to rise materially for a number of years, even despite the backdrop of rising inflation and mortgage rates at all-time lows, the prospect of a broadly stable market seems to stack up. But certainly don't take my word for it. That's for each and every one of us in this room to decide ourselves. I think there's only one thing I can predict with any degree of certainty, and John, you'll probably like this, and that's this, that England will get a good hiding on Saturday from the mighty Springboks. Now, I'm sure that's one forecast everybody in the room is dying to see. On that note, I'll hand you back to John.
Thank you, sir. Some very interesting points there, and it, of course, is very difficult impossible to predict with any degree of certainty. And as you said, the phrase countless factors, an awful lot to take into, for us as brokers, again, to take into account. And I'd now like to invite Adam to not necessarily reply, but to give his thoughts on the housing market, if you would. Thank you, Adam.
Thank you, John. I suppose my job as the market commentator, the researcher in the room, is to try and provide some statistics and support to, frankly, most of what Mark has already just rightly described. So I'll leave it to me to say thank you, Mark, for stealing my thunder virtually right across the spectrum, because I'm kind of left here thinking, broadly, yeah, about right. In terms of the macroeconomic struts that underpin our forecasts, and while it is very, very difficult at the moment, in a moment we'll share with you our views, which we only launched last week. The macroeconomic backdrop is pretty good. It's not great, but it's pretty good. So while GDP, after Brexit, downgraded, reverted a little bit back up, knocking just above 2% probably this year, coming back a little bit next year, that will still be the strongest economy in the G7. Still be the strongest economy in the G7. It may well be that as a result of last night's results, the US slide further down the scale. But at the moment, we're just pipping the United States in terms of GDP performance. So not great, but not bad. In terms of transaction levels, moving directly to the housing market, we see transaction levels coming off next year by about 10-12%. So we were on a trajectory that was looking more like 1.3 million transactions towards the end of our forecast periods over the next couple of years. In reality, we're seeing that more like 1.1, 1.12, something like that, as a more likely scenario for next year and the year after. So a bit of a tapering in terms of activity. In terms of pricing, clearly the next couple of years in a Article 50 invoked world, so let's be really clear about this and remind ourselves that in fact Brexit hasn't started yet, so some of those really material uncertainties about the negotiation still probably to manifest. As a result, we see house prices coming back from a pre-Brexit level, which was frankly high single digits nationally, above trend anyway, tapering back to something that is looking flattish next year and for the next couple of years before we start to see momentum again somewhere in 2019, 2020. There, of course, as ever, are regional variations to that story, and more importantly, city variations to that story. So at one end of the spectrum, we're all very familiar with the prime London story, what is happening in that space, and transaction levels really coming way back this year. Importantly, prices have also been materially impacted. At the very top end, we're talking about double-digit price falls. In new build terms, that's probably high single-digit price falls, but nonetheless, quite a material change there. In contrast, Manchester City Centre this year will probably do 15-16% growth. So, absolute extreme ends of the spectrum, and that's being driven in particular by a total lack of supply, while what is now the legitimate second city of the UK, sorry for the Brummies in the room, that legitimate second city status in terms of its economic performance has been, I think, enabled, or perhaps not enabled in housing supply terms, by a lack of stock over the last couple of years. That will come through. For the most part, not next year. It's really the year after where we start to see material growth in supply in that market. But as a result, in the interim, we're seeing strong upward pressure on rents and prices. But just as an example of really the spectrum we're dealing with at the moment. So in terms of trying to unpack what is happening in the housing market, as ever, a huge variation. Before I finish up, there are a couple of structural things that I want to just put in your mindset, thinking about your lending environment, thinking about the space in which you want to unpack. We've already talked a little bit about the buy-to-let story. I'm not that convinced that the international story is going to come to the rescue for prime London, particularly, or central London development, like it did in 2009-10. There are bigger macroeconomic issues that make London and the UK a little less favorable than it was then, and most of those actually are manifest in their domestic markets, places like Hong Kong and Singapore. So don't expect that to be the white knight that it was in 2010, 2011. However, the points that I wanted to unpack around the supply shortfall, Mark is absolutely right. And actually, it's much worse than he's given you a sense of. If you think about our supply chain at the moment, delivering broadly 150, 160, with a good tailwind, maybe 170, 180,000 homes per annum. That's not quite half, maybe about half of what we need in terms of overall supply. Over the next decade, we're going to lose something like 700,000 workers from that workforce because it's a graying workforce, average age moving now through 50. It is very likely that we will lose capacity during a period where we need to broadly double capacity. The ability to lever up, and I've said this very consistently in the popular press, the ability to move to that 1 million starts by the end of this parliament is an absolute nonsense. It is not possible. That is irrespective of the Brexit conversation. That is irrespective of the 40% of our construction workforce in residential in London that come from elsewhere. Take that, multiply it on top, and you've got yourself a real problem. Many looked at the apprenticeship program as the real solution, delivering something like 2,500 new employees into the construction workforce. 700,000, 2,500. 700,000, 2,500. It's not going to work. As a result, the spaces that you need to be thinking about more creatively and you're going to be lending into very likely, modular will become far more important. Really quite key. You're going to see that becoming more material part of the overall story. Build to rent, absolutely, is going to feature in the SPG, going to feature in the white paper. So a whole range of things that I think you should be thinking about as an environment or a backdrop going forward.
Very interesting points there from Adam as well. Can we just, we have a few minutes to take a few questions from the floor. We've had, like I say, the surveyors, sort of the housing, is that the right word, surveyors?
I'll take advisor.
Advisors, the advisor's point of view as well as a lender's point of view. As brokers, we need to work with them both, and of course it's our clients that need to, in these times, sort of buy well, find good lending, take advice on all sides of things. So are there any questions that we can put to the gentleman, please? No, that's all. Everyone learned everything they could. Yes. Yeah, there is no uncertainty out there. One of the questions that was put to me before, if I may, was, does the panel have an opinion on what the difference will be with the push towards the big PRS sector and the private and the smaller landlord private rented sector? A lot of us work with small to medium developers and small to medium landlords. How do you see the balance between them playing out over the next couple of years? If I could start with Adam.
Sure. Well, without question, build to rent, as it's being called at the moment, we call it private rented communities at JLL. Without question, both central and city level governments see this space as a real opportunity to provide some of the additionality in terms of housing stock. So it will become more of a feature than it ever has before. And frankly, that sector as an institutional grade sector never really existed in the UK. So British Property Federation would say there's about 60,000 units in the pipeline at the moment. Many of those are now becoming completed assets. It becomes quite interesting at the scaled space. Where that works for the smaller scale, I think becomes a little more challenging. But having said that, there of course is going to be direct support for SMEs in the construction space, which we'll hear more about on the 23rd and in the autumn statement. Invariably, a good chunk of that product will go into a specialist private rented type blocks, even if they're subscale. I see that space being a far more important space for the lending community to get their heads around.
Indeed, yeah, and a great opportunity for us as well, Mark.
Yeah. We've looked at quite a few, actually, within Octopus, on both sides of the fence, from a lending and an investing, with our investment team as well. The biggest challenge we have when we're looking to lend to PRS operators and to smaller developers in particular, actual PRS operators, it's slightly more difficult for us because we can't get the pricing right for them. But your smaller players who come to us who want to do it on a smaller scale, the biggest challenge they have is that when they run all the numbers and they get to the end, they make more money if they sell than if they hold. And that is the fundamental flaw in PRS for the smaller house builder. So until they can get that balance right and until the market shifts enough, there's going to be a lot of pressure on the smaller guys because they can see huge multiples on disposals, not as much on holding, and they want to get their money out to move on to the next scheme.
So they're more sort of built to sell.
Yeah,
so one question from the floor, please. So the microphone is coming.
Just behind you.
Yeah. That's Karina.
A question for Adam. Given the changes to the mayor in London and also the changes in national government as well, do you see a shift in attitude towards the private rented sector do you think it's going to be more difficult for the private renter sector to, particularly on the institutional side, to make the gains that it looked like they were going to make not even 6 to 12 months ago?
It's a really, really good question, and actually quite a live question, I guess, in a sense. I come here directly from City Hall, where we were having a conversation about exactly that, the space for build to rent within the new SPG. I can't talk about that because that's obviously to be announced in a couple of weeks' time. What I can say unequivocally is, in the first instance, from a national government perspective, the shift that we saw or that we have experienced really over the last few months, moving away from what was frankly a government that was focused on aspirational home ownership to the exclusion of all other tenures, to now a government that I think recognizes, alongside want, is a whole range of need, immediate need, and that's affordable rent and that's private rent. Of course, how you deliver affordable rent alongside private rent, and thinking about the build-to-rent sector, is complicated. It does become a little bit more challenging. We've heard from the Mayor, for example, on his ambitions on the London living rent. That has, of course, some very direct implications on scheme viability, and again, for the lending community that in some ways is going to have to provide the underwrite, provide the analysis. How does that income stream get supported? What is the clarity of trajectory of that income stream? What does it represent as an alternative to the for sale product, the breakup product? Those are all going to be dynamic issues that I would implore you to think very clearly about. And actually the SPG, when it comes out at the end of this month, is still being a little bit vague, and I think the reality is that they're waiting to see what comes out in the white paper and what comes out in the autumn statement to make sure that there aren't any rogue elements before the London SPG comes out. But when it does, that'll make a real difference, I think, to provide some clarity and transparency around overall that space, how it's going to be treated by, at least by this Parliament and this mayoralship.
Thank you. Okay. Well, thank you very much, everybody. Thank you for attending. Thank you, Mark. Thank you, Adam, for your thoughts. Any questions, please ask the gentleman after. And we could ask you to all put your hands together in appreciation. Thank you.
Thank you.